Good morning, everybody. Welcome and thank you for joining us in the next in our series of broker-focused webinars today. We're here to talk about something that sits right at the intersection of two of the most significant forces shaping commercial finance right now: the energy transition and the future of business lending. The UK has committed to net zero by 2050, which many of you will be aware of. And businesses of every size are under growing pressure from either regulators or investors or customers to demonstrate progress on sustainability. For many of our clients, that means increasing energy costs, being aware of carbon footprints, green credentials, and no longer just operational concerns, they're balance sheet concerns. So renewable energy, solar, wind and beyond is no longer a niche or aspirational choice. It's increasingly the financial, rational one. Falling technology costs, government initiatives and rising grid energy prices have fundamentally changed the numbers. And where capital is needed to make that transition, commercial brokers and you have a critical role to play. Today, we're going to look at how you can position yourselves as trusted advisors in this space, helping clients access the right finance at the right time to future-proof their business and meet their sustainability goals. To help us do that, we're joined by members of the team. We're joined by Alex Tate, who has 6 years experience across NatWest Group, supporting businesses accelerate their renewable energy adoption and drive sustainable growth. She's got a strong background in strategy, data and analytics and climate-focused roles across the group. It brings a really unique blend of commercial insight and expertise to her work. And Stuart, for those who've joined before, will know Stuart. Stuart has worked within the asset finance world and Lombard for over 15 years with a wealth of experience and again track record of delivering financial solutions for customers in this space. And also joined by Rakik Meir, who runs the Lombard broker business and hopefully is known to many of you, who's going to host the Q&A session for us at the end. So I want to really get straight into that. I'm going to hand straight over to Alex. Alex, over to you. Thank you.
Perfect. Thank you very much, Dave. So yeah, my name is Alex Tate and I work as a relationship director in the Lombard renewable energy team. And I'm joined by my colleague Stuart Graham today as well. So yeah, the aim for today's session is to walk you through Lombard's renewable energy offering and give you an overview of how we fund these assets, the assets that we do fund, and how broker channel leads can be shared with us to sort of get this going. So at Lombard, we have a long and established history of funding renewable energy assets, and we've been doing this since 2010. So we're definitely, it's not a new area of activity for us, and we've supported customers of all shapes and sizes in funding renewable energy technologies. So when we assess renewable energy projects and deals that come in, we do so from a position of experience and one where we really understand what customers are after in this space. Importantly, the experience that we have is embedded in a specialist renewable energy team, and you can see the 5 smiley faces on the screen at the moment. And you can see that we are also surrounded by various other sector teams. So I believe you've had broker webinars already on aviation, but we're also surrounded by agriculture, leisure marine and commercial marine. So we're a group of specialist relationship directors, but the way in which we serve customers is very, very similar. Before we head into the actual offerings that we have, Stuart is going to cover off some sort of developments and what we're seeing in the renewable energy space at the moment. So Stuart, over to you for the next slide.
Thank you, Alex. Good morning, everybody. And I think Dave's done a great job already in terms of highlighting some of these key areas. But we thought it'd be useful just to set the scene really and give some further high-level background in terms of the primary factors that are currently at play in this sector. So it's fair to say the primary driver for change is the climate crisis and the overarching commitment of the UK to reach net zero before 2050. And from a UK perspective, the previous UK government raised up its ambitions in the energy sector in 2021. The target being to completely decarbonise the UK energy system before 2035. And this has now been brought forward to 2030 by the current Labour government. And basically what it means is covering or moving from a centralised fossil fuel-based system to a more decentralised renewable-based system. And the capital expenditure required to achieve this has been estimated at around about 900 billion over the next 3 decades. So eye-watering sums of money. This level of change comes with significant challenges. and complexity, but also reasons for optimism. So, for example, in terms of the trends we're seeing, technology trends, we're seeing not only reducing costs, but obviously renewable energy generation is highly intermittent, it's highly volatile, and so there's a growing requirement for low carbon energy storage solutions. So things like battery energy assets, low carbon hydrogen, and even hydro are going to play a key part moving forward in the energy transition. And what's helping considerably, and what Dave touched on, was the trend in reducing costs in terms of this technology, which have been on a steep downward decline for the last 10 years. So, for example, solar now is one of the cheapest forms of new electricity generation globally, and in many markets it is the lowest cost source of new power capacity. Just moving on to consumer trends. So in terms of consumers, we're talking about the broader kind of definition of consumers in terms of not just Joe Blogs, but also SMEs and corporates. The cost reductions in the technologies we've just touched on have started to filter through into the smaller projects, which has helped return on investment cases for things like rooftop solar and ground mount solar. And we've started to see this play out in SMEs and corporates who are increasingly deploying these projects in order to not only de-risk energy costs, but to future-proof their business operations as well by operating on a lower carbon footprint. Businesses have also started investing in multiple technology types. So solar has been by far the kind of superstar performer in recent years, but we're seeing more battery energy storage solutions. We're seeing EV charging infrastructures. We're seeing heat pumps all being deployed. So businesses are starting to take a more of a holistic view of how these technologies interact and dovetail with one another. We're seeing lots of landowners invest in either new onshore wind, or probably more popular, they're starting to repower older turbines with newer, more efficient models. And all of these projects are important because they're displacing the consumption or historic consumption of fossil fuel-based energy, and collectively they're kind of reducing the demand on what is a very constrained national grid infrastructure. And this pressure on the grid infrastructure, the balance of supply and demand will only increase over time, and that's because the long-term trend for electricity demand in the UK and globally is upwards. So as transport, heating, and industry increasingly electrify, obviously demand will follow suit, and we're already seeing that take place. We're seeing that play out. For example, during 2025, battery electric vehicles accounted for 21.6% of all new car registrations, which was up on 2024, and the numbers are expected to keep rising. So the forecasts in terms of overall electricity demand vary by source, but the Climate Change Committee, who are at the heart of kind of the net zero pathways and working with government, they project UK electricity demand will increase by around about 50% by 2035, and that number could double before 2050. So that brings us on to the subject of politics, which I will try and keep as high level and as uncontroversial as possible, which is always quite difficult, especially in today's climate. But essentially, the Climate Act of 2008 is the primary piece of legislation that underpins our action to address climate change in the UK. And what that means is we've committed to reducing our emissions by at least 100% of 1990 levels by 2050, and that's otherwise known as net zero. And the Act requires the UK government to set these legally binding carbon budgets, which are acting as stepping stones towards the 2050 target. And it's these carbon budgets which are driving investment and driving action, as well as other sector-specific legislation, which is starting to trickle down. So, for example, we've already touched on EV registrations. And in 2024, the UK introduced its zero emission vehicle mandate, which for the first time set EV sales targets for manufacturers. And it's not just at home where we're seeing politics play an important role. Foreign policy could also have an impact on things like supply chains and the availability of key components in the UK. So prime example being the US Inflation Reduction Act, which provided nearly 400 billion of tax credits, loans, grants, etc., to incentivize the development of homegrown industries and supply chains in the US. It still remains one of the largest clean energy support programs globally, but a number of the incentives have subsequently been amended or reduced under the Trump administration, but it is still live and it is still doing what it was originally set out to do. So in terms of supply chain, just moving on to point 5, it's probably no surprise if I say China is the dominant force. If you look at the manufacture of solar panels in isolation, for example, China account for more than 80% of the global market. And the question this poses is, are we happy being so reliant on a single supply chain in relation to our ambitions to reach net zero? And that's a question being pondered by many countries currently, and the introduction of legislation such as the US Inflation Reduction Act is a direct consequence of China's dominance. The second point here is centered around the labour market and the skills required to deliver these projects, especially the larger national significant infrastructure projects, or NSIPs. Currently, there is a bit of a bottleneck in terms of things like grid infrastructure, grid connections, planning, etc. However, once these issues have been resolved, and there's a lot of work underway to resolve those issues, the consensus of opinion is the bottleneck will shift to things like long lead key components and also labour. So, do we have sufficient resource in the UK available to accelerate the delivery of these projects? Again, the estimates vary, but a recent PwC survey suggested there was a gap of over 200,000 workers, and that's just in the UK. So if anybody has any children out there wondering what to do in life, I would suggest the renewable sector could be a good place to start, which is where my 17-year-old is currently ploughing his furrow, so to speak. Yes, and last one, number 6, geopolitical events. So this one is probably the one that's probably hit home the most, because it's really hurt consumers and it's hurt them in the pockets. So there's been various geopolitical events over recent years which have impacted the energy sector and consequently had these direct impacts on consumers. Predominantly, the main agitator has been Russia, stemming from its invasion of Ukraine, which left electricity markets, wholesale markets, in absolute turmoil. And more recently, we've had the conflicts with US and Israel and Iran, and the closure of the Strait of Hormuz, again leading to price shocks in the energy market. But thankfully, not as severe, hopefully not as long-winded as the previous ones, but still persistent and still impactful on the UK economy. What it has done is probably shifted sentiment from net zero, decarbonisation, probably more into energy security as a sharp focus for a lot of consumers and SMEs and corporates. That desire to kind of mitigate those risks of increasing energy prices, which has led to increases in requests at our side in terms of deploying on-site renewable energy. So that's a bit of a backdrop. Apologies if it seemed a little bit like a geography stroke economics lecture early on a Wednesday morning, but there are lots going on. I think it's important to kind of add context, and I think it's also important to highlight there's a lot of optimism and a lot of reasons to be kind of buoyant about the opportunities that exist for us in this sector, because there's a hell of a lot of capex that's underway and that requires funding. I think it's over to Alex for the next slide.
Yeah, thanks, Stuart. So if we return to Lombard and we take what Stuart's just said there in terms of the context, and we think about the customers that we support with our renewable energy financing, we serve 2 types of customers. And I'll focus on the first one, which is what we call counterparty customers. So essentially SMEs and corporates in the UK. Essentially, these are businesses who are looking to fund renewable energy assets, primarily to use the generated energy and electricity for their own operations. And it directly links to the context that Stuart set out already. So they're looking to do this and fund renewable energy assets for a variety of reasons, primarily to gain independence from the grid, potentially reduce their emissions as well, reduce cost and reliability on a grid which could be poorly serving them, could be very volatile, but equally so incredibly linked to costs and rising electricity bills. We'll kind of go into the other 2 points around generating income on the next slide, because we're going to cover off what that sort of lending and the structure of those deals would look like. But Stuart, do you want to cover off the developer points?
Yeah, thank you, Alex. So, yeah, this is our non-recourse policy, which are predominantly designed for lending into SPVs where there is insufficient or kind of no mature revenue streams to support underwriting. So the SPV will be generating an income through an energy supply agreement or a power purchase agreement, and the PPA will be between the SPV and a commercial entity. So typically, it's either a corporate entity or a utility provider. Underwriting in this policy is based predominantly on the performance of the assets, cash flows, strength of off-taker, etc. So we'll delve a little bit deeper shortly in terms of how all that plays out. But yeah, next slide, please.
Great, thanks, Stuart. So yes, in terms of the counterparty lending, so lending to SMEs and corporates in the UK, what does that actually look like in practice? So what we're looking to do here is lend to businesses that are established and have a mature and established income stream already. So not your traditional startup businesses. And that's really because we rely on that mature income stream to service the debt for the renewable energy assets. And we've already covered off sort of the reasons why customers might look to fund these renewable energy assets. But again, it's things like reducing emissions, reducing costs, sort of alleviating that reliability on the grid. In terms of things like the funding term and how long we tend to look at these assets, the deal length for, we can fund up to 7 years. I would say it really differs depending on the technology. For solar, you've got a pretty quick payback period generally. So customers might look to fund it over maybe 4 to 5 years, but we can be very flexible going up to 7 years. In terms of the assets that we actually fund, we've got a list at the bottom left-hand side of the screen. So you've got things like solar PV, onshore wind, battery, LED lighting. It's quite an extensive list, and you'll see there at the bottom or at the end, we have other. So that's really our way of trying to expand our appetite of renewable funding, along with what customers are looking for us to fund for them. I would say as well, Stuart and I definitely view this as a growing list. We're very keen to grow it, but we kind of have to be led by what customers are looking for us to fund for them and provide support with. So if you are looking at this list and you're thinking, I've got a customer who wants to fund an asset but doesn't fit on here, don't be put off. We will definitely look at it, and we'll work with our credit teams, look at the scientific papers to actually understand the asset and see what support we could provide. I would also say we get a lot of questions about things like anaerobic digestion. We do absolutely look at funding that, but we tend to do that on a refinance basis, and generally looking for 12 months of performance to ensure that the project actually is sufficiently operating and working as we would want it to. Another thing that we can do, which is sort of unique to the Lombard offering, is that we can fund 100% of the net project costs. So that includes things like installation, construction, and on occasion, things like pre-inception facilities for exploratory works. And that's traditionally reserved for really strong performing counterparties, but we'll absolutely look at it on a sort of case-by-case basis. Now, in terms of how we actually assess the serviceability of these deals for customers, as mentioned, we look to lend, we rely on businesses having a mature income stream and being well established. So having the most up-to-date financial information is really important for us when we're looking at the transactions. One thing which we absolutely should mention is that obviously with these assets, they have the ability to potentially save customers costs on electricity, and equally so if they're exporting some of the energy through things like a PPA, a power purchase agreement, or a contract, then we can take some of that projected income into account for the serviceability of the transaction. So for the majority of our assets, we can take up to 50% of the projected savings or income generated into account. And for solar, we can stretch it to 75% because we're really comfortable with how those assets perform. So an added benefit for solar there as well. Yeah, I think this sort of covers off the the deal structure pretty well. I would also just say in terms of the actual structure of the transactions, we use a hire purchase facility for all of these. And just to cover off what that would look like, usually customers make an initial deposit, but it can be as low or minimum as VAT only in this case. And then they repay the full value of the asset through regular installments over an agreed period. We can also look at things like balloon, sort of adding those onto transactions as well, but that's obviously dependent on the serviceability, but it is absolutely something that we can offer. Another key point here is as well with flexibility. We recognise that particularly with some assets like solar, obviously in summer right now we're seeing very high levels of sunlight, so therefore you're going to potentially have more income generating opportunities now versus the winter months where those sun shining hours are just so much lower. So therefore we've got flexibility in terms of increasing and having seasonality of payments and potentially paying more during the summer months versus winter. So there's a lot of flexibility to consider. And that also extends to interest rates in terms of having fixed or variable, very much depending on what the customer would prefer. There's quite a lot of context here, so happy to take questions afterwards. But Stuart, I'll pass over to you for the project finance element.
Thanks, Alex. Yes, so this is the back onto the non-recourse policy, and I suppose it's directly the kind of the opposite end of the spectrum to the counterparty policy. So we're lending into an SPV. We've not got a existing trading business with underlying cash flows. The SPV will be brand spanking new in most cases. The projected cash flows will be kind of generated from energy service agreements, PPAs, and it's the projected cash flows that are the determining factor in relation to what debt quantum we can get out of the door. The projected cash flows therefore need to be reliable, bankable, and so our focus is really on mitigating any risks associated with delivery of those cash flows. And that typically involves being very selective with the ultimate sponsors that we're dealing with and the delivery partners. So in simple terms, sponsors need to be liquid, need to have very deep pockets, and the delivery partners need to be, very experienced in delivering similar projects. So good experience in the sector. The projects themselves will need to benefit from long-term contracts, which are either government-backed, so things like CFDs, or there'll be PPAs, power purchase agreements, into investment-grade off-takers. So kind of counterparty risk in terms of the off-taker needs to be minimal on the basis that these cash flows are sometimes over 15, 20 years. The technologies that we're funding are well established, so things like solar, battery, peakers, wind, and they're often through very strong, reliable OEMs. And our structuring is often very conservative. So it's largely determined by the makeup of the revenues and the cash flows. So, essentially, the more contracted the cash flow stream, the better. The more debt we will be able to get out the door. If it's more merchant or unreliable, the appetite is going to be very minimal, or the debt quantum is going to be much reduced. And these projects go through a very comprehensive due diligence process as well. So we'll be instructing external legal advisors to go into the ins and outs of contracts and give us a full DD package on how the project and the SPV has been set up. We also instruct external DD providers in relation to the technical side of it, the insurance, and things like the financial and model audit. So there's a lot of work that goes into ensuring that the project is bankable, and then we essentially take a full security wrap over the SPV so that if anything does go wrong, we have the benefit of stepping and hopefully offloading the project or finding somebody to come in and partner. Because the projects are so involved and because there are quite a lot of costs in terms of setup, the minimum deal size is quite often restrictive in terms of we wouldn't really be looking at anything below 10 million for this policy. We have done smaller ones around 4 or 5 million, but only if there's a wider pipeline of delivery that we can then hook into and kind of justify the original expense of getting project number one away. But that's the non-recourse policy, and as per Alex's suggestion, happy to take calls at the end of the presentation if there's any queries.
Perfect, thank you. It's over to me now. So what we thought we would do is just walk you through some very high level and anonymised examples of the funding that we've provided, just to help bring it to life in some different customer cases. So the first example from a counterparty perspective is a very recent solar transaction that we provided for a company in the healthcare sector. It was 3.4 million in terms of volume size, and it was a really interesting deal because the company basically was looking for us to help with financing the installation of solar across their property stock in the UK. So it wasn't just one or two premises, it was properties and locations all across the country. And the need from the customer to do this was because they have a net zero strategy, so therefore they've got a need to reduce their emissions from an own operations perspective, but equally so under huge cost pressures. So having that ability to sort of look at solar was really important to them. The way in which we did this was obviously a phased approach, given that they had quite a few properties to look at, and we looked at the highest solar potential properties first, and then we sort of worked backwards from there. So yeah, a really interesting transaction, very cool to do one across the country for one individual company. The second counterparty deal is one which is much smaller in size, but we see a huge number of deals at this level, and it's really easy to see the impact of these projects pretty quickly, which is really nice to see. This was a solar and battery deal for a customer in the agriculture sector. It was 210k, and it was financed over 4 years, so slightly shorter to the 7-year for the other company that I mentioned. And essentially, the customer was looking to basically reduce their reliance on the grid and the volatility that they were seeing in terms of how the grid was serving them, and equally so the prices of their electricity. Solar and battery deployment is something that we see consistently more and more, and we're seeing customers who had invested in solar assets and are now looking to invest in battery as well a couple of years later. So that's definitely a development that we're seeing more and more in the across the UK. Stuart, over to you now.
Thanks, Alex. Yeah, so the first project finance deal there on the left was for a 26 megawatt solar site in Kent, and there's a bit of context there in terms of how large it was and kind of the impact it could have in terms of powering 7,500 average households annually. So this project benefited from a long-term 15-year contract for difference, which provided the bankable revenue stream which we needed to support the overall kind of credit profile in the transaction. We provided a £15 million senior debt facility for this one, which supported the project through construction, and then flips into a longer term operational facility once the project reached the kind of commercial operation date. So yeah, good example of a government backed scheme which has obviously resulted in getting some bank money out of the door essentially. The second one there, the second project finance deal, was to support a renewable energy developer who specialised more in corporate PPAs. So as opposed to government-backed CFD, this was a large-scale private wire project. So we provided a £39 million facility on this one to support the refinance of operational onshore wind and solar. So essentially one funder had got the project through construction. The developer then looked to flip it into a more competitive operational facility once it had reached commercial operation date, and we bid and were successful in winning that particular project. So the energy here was being supplied under a long-term power purchase agreement into an investment grade corporate off-taker, which again provided that bankable income stream we needed. But I think it's a great example of investment decisions that are currently underway in the UK, in corporates, SMEs, businesses looking to decarbonise, which has led to a very significant funding opportunity for us to get involved with. So delighted to delighted to have delivered both last year. It was actually my colleague that worked on these, so I'm here taking all the glory. But yeah, there was a lot of hard work behind the scenes by a colleague who delivered both of these in 2025.
Morning. Hi. So my name is Rakik. I'm the director of broker for our Lombard business. So thank you, Alex and Stuart, for the presentation today. If you're an introducer and you'd like to discuss an opportunity with us, you've got the contact details for your BDMs across your screen right now. We will share this out later as well, so you've got their up-to-date details. We'll also provide their email addresses as well. If you'd like to send in a request or a proposal, please send it in via the introducer mailbox. The email is there, introducer@lombard.co.uk. You've got the broker desk's main phone line there as well. For anything that's of a lower value, sub 250,000, then you can use the introducer portal and transact and send your proposal in via there. We've got some great questions coming in, so please continue to send those questions in. But if we can now move into the Q&A stage, we'll bring Alex and Stuart back to capture some of these. So I've got the questions here. So the first question today is, what are your terms around supplier stage payments in the build-up to the installation? Stuart, do you want to maybe pick that one up?
Is this in relation to, I assume it's in relation to the counterparty side of things?
Yeah, if you want to capture that, and then maybe Alex can pick up on a standalone transaction, perhaps.
Yeah. So Alex referenced the fact that we support through things like pre-inception. So essentially, a lot of these projects, whether it's counterparty or whether it's non-recourse actually, but counterparty, you will have stage payments that are required to get the project through from kind of order to equipment being delivered on site to actually the project going live and electrons being generated. So we're sympathetic to that requirement. Not everybody has £200,000-300,000 lying around spare cash flow to get the project working. So for the right customers and for the right risk profile, we would support through pre-inception loans. So essentially unsecured loans for a period of up to 9 months to get kit delivered and up on the roof or whatever it might be. It might be battery assets or charging infrastructure. But yeah, there's a facility there available for support to get these projects up and running, essentially.
Thanks, Stuart. Next question is, do we fund anaerobic digestion?
Yes.
Alex, do you want to take that one up?
Yes, I can take that one. Yes, we get quite a few questions on this. Yes, we do fund anaerobic digestion. Our policy is a little bit different towards anaerobic digestion than others, whereby, I think I mentioned this earlier, but we would look to do it on a refinance basis, and we would aim to have 12 months of operational data to sort of verify that the AD plant is working correctly and that sort of the management and the day-to-day operation of it is, absolutely A-OK. The reason that we take this is just because there's been, not necessarily with ourselves, but in the broader marketplace, we do keep an eye on sort of technologies which are emerging, but equally so maybe are less proven. AD is very well proven, but there are just more challenges with day-to-day operations. So yeah, we would look at that sort of 12-month data point, and then we would look to potentially refinance that.
Thank you, Alex. Next question. Would you do a retention deal where the install is expected to be completed within 90 days? Stuart, do you want to pick that one up?
I think instead of retention, we'd probably go down the route of pre-inception, to be honest with you. It I think result in the same benefit the customer in that, we're paying out probably up to 80-90%. And then holding back that final 10-20% for snags, etc., which we would then pay out and crystallise into the longer term facility. So I think it's viable. We could definitely have a look at it. Yeah.
Great, thanks, Stuart. Next question is, will you fund the installation costs, and if so, at what level? Alex, do you want to pick that one up?
Yes, we would fund installation costs. So we cover off 100% or we can fund 100% of the net project cost. So that would include installation. if you also think about with roof mounted solar, you need racks for the solar to go on top of. So we would fund those as well, as part of the overall installation in the project, because we kind of view it as you can't have the solar asset without having the equipment and the framing with which it sits upon. So yes, we would absolutely look to do that. I guess there is a point where we view what proportion of the overall deal that makes. So we kind of, it really is a deal by deal basis. But say if, for example, the installation and all of the work that went around the asset was 90% of the overall cost versus the renewable asset being 10% of the deal, that would be a different conversation to maybe the installation and the support that goes around it being 20 or 30% of the deal. So we're absolutely open to it, but there does come a point where we would maybe look to review it.
Thank you, Alex. Another interesting question. How is it different to do a lease purchase on solar rather than a HP? What happens to the assets at the end? Stuart, do you want to pick that?
I mean, our facilities are all lease purchase. So yeah, the typically happens at the end is there's an option to purchase fee, like you would with any other asset really, car, van, trucks, trailers, etc. And once you get to the end, pay the option to purchase fee. The kit is yours. It's on balance sheet funding. It's just a means to ownership really. So I couldn't really comment on the HP side of it. We predominantly use LP lease purchase.
Thanks, Stuart. Another question is, if we're funding solar onto a roof, would we cover the funding costs to strengthen the roof joists to put the solar on top? Alex, do you want to pick that up?
Yes, very valid question, because we do have quite an aging housing stock and building stock across the UK. I think we would so we would support that. Stuart, I'll let you come in just in case we have a different view. I haven't seen any deals come through since I've been in the team where we've looked to do that, but I think it's certainly a very valid thing that probably some more requests of. So I would say yes, but Stuart, do you want to have the final answer on that?
I think it depends sometimes whether it's we're part of the NatWest, so 30-40% of the time the customer is banked with us as well. So there are other means to kind of roof repairs, etc., through potential bank funding that could help, which might be more suitable. If that isn't an option, then back to Alex's point earlier, I think we'd look at it all on a case by case basis. I mean, if you've got a really strong business, then I think we'd look to support where we can. Essentially, I mean, the kit on the roof sometimes isn't as valuable as kind of you would like to think. So if another 20-30% in terms of project costs is an enabler to actually getting the solar on the roof, I think we'd probably have a look at doing it for a strong business. But yeah, back to Alex's point, it'd be case by case, I think
Rakik's
he's overheated apparently, which is quite ironic given we're talking about sustainability and net zero and the likes. So I guess, Stuart, given the volatility that we're seeing with interest rates, etc., at the moment, how do we protect for customers? Obviously, because energy costs are up and down, finance costs are up and down. How do we help people keep an eye on that?
Yeah, so I mean, again, Alex touched on it in the presentation. We've got the option of fixed and variable. So unfortunately, we don't advise on where interest rates are going. We have an opinion, but a lot of people are choosing to fix at the moment just because they like the surety of a fix. There's certain people that are going for variable because they believe interest rates are going to be coming down shortly. But it's what works for you, really. If you want that reliability of a monthly commitment that's not going to change, then go fixed. If you're a little bit more of a betting person, then go variable. So those are the options. You've also got the ability to structure the payments if you want to. So again, to Alex's point, there's a lot more generation in the summer months, especially with solar, obviously. So better cost savings. You can accelerate the payments during those periods, and then slacken those off during winter months, and set that up from day one. So there's a lot of flexibility there if you need it. And key would be just to keep the conversation open and understand what the customer needs, I suppose.
Okay, thank you. Alex, any builds or?
No, I think Stuart's covered that perfectly.
Yeah. Okay, good stuff. We've got a question from Vivek. Rakik's back now. I can see he's cooled down slightly. So a question from Vivek, which is more around strategy and how we would approach long-term green energy and green energy finance strategy. So balancing near-term commercial factors, margin fees, etc., versus longer-term priorities such as building capability, stranded assets, all those bits and pieces. I know we've got some work available around that. So I don't know if you can give the audience perhaps a view on that. I know it's quite a wide topic.
Yeah, it's quite a broad question, but it's a really timely one. So the other side of my job is looking at the sustainability strategy for the Lombard business, and we're actually presenting our updated strategy to the business next Thursday. So quite a timely question. It's a ginormous topic, and it's something that we are definitely wrangling ourselves with. As a NatWest Group, our sustainability strategy, we came out very hot in 2020 with what our view was, and it was all centred around net zero by 2050, and that very much covered all the entities, including Lombard. So we're very much working towards that. And I think we've made huge progress with that, but I think we need to remain focused on actually what we can support our customers with. And that is directly what the strategy is looking at. I think in Lombard, we have a really interesting sort of dichotomy mindset. Where we are part of the overall C&I commercial and institutional bank within NatWest Group, but equally so, we are the largest asset finance provider in the UK. So we have an interesting role to play where we very much play part of the bank, but equally so we are leaders in the asset finance industry. And I think from an asset finance industry perspective, we need to remember that we have quite a big responsibility to play in terms of guiding the industry, setting the standard for the assets that we want to fund, etc. I think, to put it in the best way, it's really in terms of matching customer demands and ensuring that we are being proactive in being able to support customers with these new and renewable energy assets that they want us to fund, and being there to support them when the time does come for them. I think we've done a really good job at sort of demonstrating the appetite and the approach that we have. We've been funding these assets since 2010. But I think when it comes to new technologies and the ones that we're not so comfortable with funding yet, but potentially will be really important in the future, that's where we need to take a proactive mindset. And that's what Stuart and I are really looking to do with the work that we have. So yeah, quite a broad question, but hopefully that showed that we're very much looking at that. And I guess on the topic of stranded assets, it's very much something that we're looking at. Like, we review all of the assets that we fund, and we're working with our internal teams on sort of what reviews that we can put in place to really understand what risks we have from a sector perspective, what policies coming down the line, and how that's going to shift the assets that we have and the customer demand. So there's a whole load of things, but it's a very active and growing space for us.
It is, yeah. Thank you. Great answer. And I guess, Vivek, and to the audience generally, the whole reason for putting on sessions such as this is to hopefully prompt some conversations you can have with the clients and introducers you have to start thinking about the longer term strategy that your customers may or may not have, i.e. if they're in buildings or they're looking at different ways of approaching sustainability, so we can build a pipeline of opportunity and support for those businesses. So again, our ask of you is to take what we talk to you about and go and have those conversations elsewhere. And certainly the BDM team, Stuart and Alex, are there to support with that as well. I think we are out of questions now. I think we've finished those. So Alex, Stuart, thank you so much for that. Question and ask of everybody just before you all dash off. We will put a survey up at the end as you leave. Just please, if you could spare us literally 30 seconds, if that, to tell us it's been useful or not useful. And a big thank you for Rakik, who's been struggling with tech and overheating. There's probably some conversations we need to have with you about buying some new tech. But again, thank you everybody for joining today. Please do fill in the survey, and we hope to see you at the next one.